In the middle of 2026, the massive dam holding back institutional capital in the crypto markets cracked under the pressure. This chart tracks U.S. spot Bitcoin ETFs over a brutal 13-day stretch. Assets plummeted from $104 billion down to $80 billion, as $4.4 billion bled out. This panic came from the top. Hedge funds slashed positions by 39%, dumping tens of thousands of Bitcoin. That anxiety immediately spilled over into prediction markets like Polymarket, where liquidity surged into volatile bets on how far and how fast Bitcoin prices would fall. It raises a rather expensive question. Why did the smart money suddenly sprint away from an ecosystem they had just spent billions to enter? This capital flight was a structural panic, a response to a new, invisible threat aimed squarely at the network's foundation. The trigger for this exodus came in April, when 2 consecutive crypto hacks shattered network defenses, draining nearly $600 million in a matter of days. Investigators tracking the stolen funds quickly realized they were dealing with state-sponsored actors, specifically cybercrime groups operating out of North Korea. But the massive leap in the attackers' capabilities alarmed cybersecurity experts far more than the dollar amount. The hackers had begun feeding their operations with advanced artificial intelligence. Decentralized finance, or DeFi, is uniquely exposed to this. Its open-source smart contracts, the automated code that executes trades without a middleman, sit in public view, waiting to be read. By deploying AI to autonomously scan contracts, hackers compress the time to find a zero-day exploit from months down to hours. Once exploited, the blockchain structure guarantees the theft is irreversible. With no central authority, there is no one to reverse the stolen funds. AI weaponization has permanently broken the risk-reward ratio of decentralized networks. Terrified institutional capital needed a place to hide, and they demanded a secure alternative. While the decentralized markets bled, traditional megabanks were quietly preparing a calculated response. Their opening came in July 2025 with the passage of the Genius Act. This legislation finally gave U.S. banks a federal path to build and control their own blockchains. Under the new rules, nationally chartered, FDIC-insured banks received the green light to issue payment stablecoins, digital dollars backed one-to-one by cash sitting securely in the Federal Reserve. This diagram illustrates the stark difference. On the left, legacy crypto stablecoins rely on opaque reserve pools. On the right, bank-issued stablecoins sit inside federal supervision. They also introduce tokenized deposits, digitizing actual bank accounts onto a blockchain within existing regulatory boundaries. The Genius Act provided traditional finance with the blueprint to legally clone crypto's underlying technology without assuming its risks. That blueprint led to an ambitious endgame, the clearinghouse's tokenized deposit network, slated to launch in the first half of 2027. Built and operated by banking titans, Citi, Wells Fargo, and Bank of America, this infrastructure will directly connect traditional payment rails to digital assets. It operates as a completely walled garden. It offers the same 24/7 instant settlement of a public blockchain, but access is strictly restricted to vetted institutional clients. By merging the cryptographic speed of Web3 with the credit risk profiles, compliance teams, and FDIC insurance of a megabank, traditional finance engineered the exact sanctuary needed to catch the billions fleeing the open market. Look at this network map. The reality of mid-2026 is a massive rotation. Institutional capital is abandoning public blockchains, funneling into private bank networks. Rather than destroy the technology, traditional banks are weaponizing it to defeat the decentralized market at its own game. The spike in AI-driven hacks provided the exact existential threat the big banks required to justify a closed, proprietary system. It's a calculated compromise. Banks are extracting the pure utility of the technology, instant, borderless settlement, while systematically stripping out the founding ideology of decentralization, anonymity, and permissionless access. The underlying technology of the blockchain revolution actually succeeded, but as the old financial guard moves in and bolts the gates shut, the original revolutionaries are the ones facing eviction.